All right. Hello, everybody. This is Mike Rixey. I am the lead options instructor for Netpicks, and this is our options trade of the week. Over the past few weeks, it's been an incredibly challenging market. We've had volatility explode higher to historic levels, really. I mean, it's been a very rocky stretch for markets here over the last week or so. And a lot of it has been due to the spread of the coronavirus worldwide, just wreaking havoc on these markets. Well, not only is it giving us historic volatility, but it's giving us historic range in the market. We've had big moves back and forth, and I want to walk you through some ways that you can take advantage of that movement going into next week. I'm actually going to give you two different ways of taking a bullish trade on Dollar Tree, symbol DLTR. From a fundamental perspective, it makes sense that DLTR has actually hung in there and started to bounce the last few trading days. With economies worldwide starting to slow down because of the spread of the virus, people are looking for deals, right? They're looking to save money, and stores like Dollar Tree are going to be an attractive choice for many cost-sensitive shoppers, right? Well, when we take a look from a technical perspective, we just build off of that. I'm not so much a fundamental trader. I like to focus on the technicals. And here's what I'm looking at. This is the 195-minute chart of Dollar Tree. It gives us 2 candles a day instead of the one that you would get if you're looking at a daily chart. It's a sweet spot that we have identified over the years. It gives us a really good opportunity to react faster rather than using the daily chart. But it also still does a good job of keeping us out of some of those choppy markets that we can see, which is what we all want to try to avoid long term. Well, I want to highlight two different indicators that we're using here at the bottom of the chart. I'm going to walk you through two different trade types that you can use depending on how aggressive you feel comfortable being going into next week. The first one we're going to talk about is our pulse indicator. It's that red and yellow histogram down at the bottom. And you'll notice that we had a slew of yellow bars last week on that pulse. Those yellow bars represent price action getting to between a 1 and a 2 standard deviation move on the downside. In other words, we're oversold. Doesn't mean we can't see price action move lower from here. It just means it's not statistically probable that it'll happen. In all likelihood, when you start to see this pattern where we've had a nice sell-off, we hit an extreme on the pulse indicator, we get a whole slew of yellow bars. In many cases, it'll lead to either a period of consolidation or even a reversal to the upside. We already started to see that last week as markets continued to move lower. Names like Dollar Tree started to bounce as we started to see more signs of economic weakness here in the U.S. Well, what I need to have happen, I need to see 3 out of the past 5 bars plot yellow. We had that. We then got price action actually close up above our red and blue moving average up top. That is what we call our Netpicks moving average. It's simply an 8-period exponential moving average, but we have added some color coding into it. If it's moving to the downside, if it's trending lower, it'll plot red. If it's trending higher, it'll plot blue. Well, we did get price action to confirm up above the moving average. That gave me confirmation that we're ready to head higher, and that opens up the door to sell a put spread, which is what we're going to talk about next. Selling a put spread is going to give us multiple ways of making money on the trade. We don't need a big move higher. If we get it, that's fine. But the put spread, selling a put spread will also allow us to make money if we just move sideways or even drift slightly to the downside next week. The second indicator that we have is what we call our sentiment indicator, and that's the red and the green histogram down at the bottom. Notice at the end of last week, we saw the sentiment go from bearish to bullish. We saw it go from red to green. Once price action closed above the moving average, that would also give us the opportunity, if we wanted to be more aggressive, to buy a long call or a call spread. So we're going to take a look at both buying a call option and then also selling a put spread. You don't need to take both. You can take one or the other, but I'm going to give you 2 different ways of putting on a bullish trade on Dollar Tree going into next week. So let's jump over to the trade page and let's talk through this in more detail. So let's talk about the short put spread first. This is a more conservative trade. It's going to tie up less capital, and it's also going to give us multiple ways of making money on the position. It doesn't have the home run profit potential, but it does come along with lower risk and a higher probability of success. So what we're going to do is we're going to go to the put options on the right-hand side of the Thinkorswim platform. I want to go to the out of the money put options, and I'm going to go to the 70 put. The current price of the stock is at just under 76. So we're going to go about $6 out of the money. I'm going to right click on that 70 put, go to sell and go to vertical. That's going to pop up an order down at the bottom where I am selling the 70 put and I am buying the 65 put at the same time. As of the close on Friday, this position was trading for around $2.22. The minimum price that I want to collect is $1.50. If I collect anywhere from $1.50 on up to $2.25 or so, it would leave me with a really nice risk-reward scenario. If I get filled at $2.22 first thing Monday morning, it's going to leave me with a situation where I am risking $278 to make $222. We're slightly worse than risk one to make one. The $222 that I am collecting to put the trade on, that is the most I can make on the position. If Dollar Tree zooms to the upside by another $20, the most I'm going to make is $222. I am giving up my home run profit potential in exchange for a much lower cost on the trade, and I'm going to have multiple ways of making money on the position. Right? So the cost of the trade, the most I can lose on the position is $278 per spread. My break-even point would be at $67.78. So it would give me roughly, you're looking at about a $7 to $8 cushion here, where Dollar Tree could move to the downside by $7 or $8 before I was in trouble. The only move that hurts me is a big move lower here, which I'm not expecting because the market's already oversold. Any type of a move to the upside, small, medium, large, doesn't matter. If we move sideways, I can make money. So up, down, or sideways, I make money all three scenarios. I make money from time decay adding up. Every day that passes, that's going to help me. And then I make money from volatility decreasing. That's going to cause the options to get cheaper, which is exactly what I want to have happen. So now I give myself 5 ways of making money on the position. It's a risk-defined trade. I know what my maximum loss is up front. So in this volatile environment, I feel better about that. Knowing that I'm not going to blow out an account, I'm not going to face large losses here. This is a safe way of approaching a very volatile environment. So that's the first option for putting on a bullish trade on Dollar Tree. Let's compare that to buying a long call. If I were to come in and just strictly buy a long call option, let's just say I came in and bought the 75 calls. Okay, the 75 calls are the at the money strike. Well, you're looking at between $600 and $800 per contract to put on that position. They're more expensive, right? The short put spread, we're talking about just under $300 of capital required. You're basically going to double that if you wanted to buy the at the money call. If I wanted to go in the money, I would have to go up to the 70 call. And now all of a sudden you're looking at between $700 and $1,100 per contract. I like to trade the in the money options. I think it's a better position overall. The time decay has less of an impact and you're just getting a higher quality position. If I buy a long call option here, I like the 70 call. And just from the close on Friday, if we place this order down at the bottom, so I'm going to left click on the ask price of the 70 call. It's going to create an order down at the bottom. And if I get filled at the mid price, and when I say mid price, I'm talking about the mid price between the bid and ask. The bid price is $710. The ask price is $1040. A lot of times what I like to do is place my order at the mid price, which would have me looking at about $880 per contract. So it is tying up more capital. It does take on more risk. What we like to do with our long call options and long put options as well, for that matter, anytime that I'm buying an option, we like to use a 50% stop. So if I pay $880 for this contract, I'm only willing to risk half of that. So my maximum loss would be $440. So you are taking an additional $150 to $170 of risk compared to the short put spread. But in exchange, you get an unlimited profit potential, right? So as long as that stock moves to the upside, you're going to make more money. It's a higher risk, higher reward type of scenario. The long call is going to have a lower probability of success. The short put spread is going to have a higher probability of success. So it just depends on how much risk you feel comfortable taking. Which one do I like? I like the short put spread here. I like the lower risk, I like the higher probability of success, and I like the 5 ways of making money on the position. In a high volatility environment, I would rather sell a spread here because the options are very expensive. Selling a spread would allow me to take advantage of the higher prices on the options. I like this scenario with the short put spread, just given the current market conditions. Again, both are bullish. Both ideally want the stock to move to the upside. You're just going to have a more forgiving trade with the short put spread. So we'll continue to talk through both of these going into next week. I'll be back next week. I'll update both of these positions. We'll track them next week. And then we'll also update our VXX position that we put on last week as our options trade of the week. So we'll definitely keep you posted on all of these trades. If you have any questions in the meantime, feel free to send me an email, mike@netpicks.com, or post a comment here in the blog post or on the YouTube video, and I'll certainly be in touch right away to help out. So I'm going to wrap this video up here. Again, we'll be back next week. We'll update all of these trades, let you know how we plan on managing them. Enjoy the rest of your weekend, everybody. We'll talk to you here next week.